Hello everyone, welcome to Equity Sciences, an exciting new firm that designs an intelligent, adaptive, quantitative solutions for clients who wish to journey beyond buy and hold. Leverage our years of research to deploy advanced intelligent concepts in a quick and simple fashion. Today is just a brief introduction into some of our products, services, and differentiating factors that separate us and our concepts from other quantitative firms, from other systematic strategies. And so today we'll primarily review our two main product groups. And so we have systematic strategies that can be deployed and customized on your end. So those products are purchased and then you upload them to your trading platform and either deploy a semi or fully automated and or incorporate within your discretionary analytics and or confirmation processes. And then we have signal services, and signal services can be from both a systematic strategy perspective and or our allocation sciences line. And so our allocation sciences line are allocation models that are designed specifically for clients that may have slightly longer term position hold objectives. And so these concepts do not deploy logic that identifies optimal entry and exit prices necessarily. They deploy a combination of market classification and multifactorial value to dynamically adapt the percent allocated at the close of each bar. So these allocation models can be applied to various frequencies, even multiple frequencies to the same asset. So a 45-minute frequency, a 40-minute, a daily, or a weekly. And so you can get extremely creative. Every product and service that we design is designed to be extremely versatile and adaptive. And so we understand that the wide and ranging preferences. And so everything needs to have the ability to be able to be customized for more specific price characteristics for specific preferences as well. And so the allocation products as well as the systematic strategies that come with open code, access to inputs can be further tuned to each market, can be applied to additional markets if you wish. And so today is just, again, a brief review of some of those products and services. And so I'll start today by reviewing our SPY systematic strategy. It's called SPY Outcome. And so this deploys our market classification, which identifies or applies an optimal entry, exit, and allocation percentage based on each classification. And what I mean by market classification is we break things down to 64 different market environments and substructures. So here is just a very generic review. So we look at multiple frequencies of price movement. These are just, again, very basic analytics I'm sure many are familiar with. And so, again, we look at basic analytics of price movement. And then we look at, cyclical and current volatility. And then we break things down into directional movement. So the theme is the same, okay? And so each one of these classifications would technically deploy its own individual model. And so time and time again, our research routinely reverted back to sourcing out why other quantitative strategies fail is that outcome is too correlated or dependent on a perspective of singularity, either a single market environment, single condition, a single source of alpha, or a single variation of value. And so every structure that we implement seeks to magnify the benefits of diversification. However, not elementary allocation or diversification from an allocation scheme perspective, such as traditional methods, but diversification on a per asset, per strategy, per valuation of variation of value perspective. And so that's why you see all of our products and concepts will allow for multiple entries. Multiple entries allows us to exploit multiple types of value or sources of alpha intra position. So it helps us to increase the probability of a positive outcome on a per position basis. And then in addition to that, it creates the framework or the structure for us to deploy more intelligent allocation control modules. And so now we can identify the optimal allocation on a per entry, per position, per condition basis. And so all of these entries will deploy, a different percentage. And then when you use close price as a divisor, again, you'll see a common theme, and all of our concepts deploy some type of value. So we want to buy at some type of value, whether that's, reverting, random, or cyclical. And then our allocation model is designed independent, and we really aim for our supportive structures to mitigate, to seek to mitigate the many risks that are associated with quantitative concepts. So while we're allowed to be specific due to classifications, we don't want additional structures to increase the risk of failure. We want those to mitigate. So we really seek for the initial entry to be the most efficient. But we're not always going to be right, because randomness and price characteristics and the sequence of movements will never exactly be the same. So we come from every perspective, knowing and understanding that we're not always going to be right, and so we're trying to increase the probability that if the somewhat stochastic range of randomness, is high, then allowing multiple entries still nurtures that position to close with a positive result. And so here you can see the a general simulated result for the past 20 years or so. Again, the amount of alpha sample for this specific product is approximately 22 months. And so you can see how it handled, the recent COVID volatility. And, our models are designed to seek to kind of slightly outperform during bull uptrends. However, significantly outperform in consolidations, volatility, etc. And so here is an example of one of our allocation models. I also added an individual profit target to this, so this isn't exactly probably representative of how some may choose to deploy the strategy. But again, this shows the versatility. With just adding an additional profit target, you can completely change what you're trying to accomplish, and that gives you the ability to really build a complete diverse portfolio. So you can deploy the same model across various assets, but then tune those the model inputs or values to each market individually, as well as add certain exit logic that allows you to really diversify strategically. And so here is a simulated result for QQQ over the past 20 years or so. And so again, the allocation model, the trade frequency is very high here because it has the profit target applied. But technically speaking, if that wasn't applied, position holds would be a little longer. And so again, the allocation model is designed for clients who have more longer term position hold objectives. However, that doesn't necessarily have to be the case, as you can see here. Here's another example of the allocation model applied to another asset and another platform, and so you can see it allows for stepping out. So you step into positions and you can step out. So our allocation sciences line of allocation models, we have V1, V2, we have MCV1, MCV2, and then we have Dyne1 and Dyne2. And so those are basically the MCVV1 and 2 both combine market classification and multifactorial value, and then Dyne1 just uses multifactorial value. And so, but both of them are extremely versatile from an application perspective. So you can choose to deploy it however, and customize it, tune it, optimize it, so they can run as either a semi or fully automated strategy, and or again incorporated within your discretionary analytics. And so our products and services are meant to be deployed either as on your end, so they're purchased and then you deploy them, which we help and assist within that process, and we always maintain an open door policy. We really seek that our customer service is equal to or greater than the amount of effort and time that we put into the development of the actual product itself. So it's to our benefit that our clients are successful and become familiar with our concepts and products, and really have an ease of application. And so, all of the products that are purchased come with open code, so you can open them up, look at all the analytics and structures, and learn from them. So that you're not just deploying a product; you're also learning, new ideas, new concepts, and you can combine those with maybe some of your current strategies. And so, we're really looking to serve multiple objectives here by offering these products in open code format. And so, many firms don't do that, obviously for IP reasons, but we found that there's more to benefit from a client end, and so that's really what we're here for. And so, again, our products are broken down into products or services. Products are mainly purchased and then deployed on your own, or services such as signal services, whereas we deliver the signal to you via email. And so, for instance, an allocation signal service, basically, in essence, for either our sector and index ETFs package or our large cap stock package, we would basically update the percentage delivered to you every day. So extremely easy to follow for those who may not have a significant amount of time to allocate to analyzing charts or deploying concepts or executions, etc. And so one thing that we really strive for is the simple application or interpretation from a client perspective. So it's extremely simple to really get going with the product pretty quickly. And so here is another example of another allocation model applied to SPY. Again, this is just another variant. And again, the trade frequency here is kind of high. That's just the way this specific model has been tuned. It doesn't have to be tuned that way. It can be tuned very differently. And so these, again, don't identify optimal entry and exit prices. They mainly seek to identify the optimal percent allocated at any point in time. And those values always update at the close of every bar, whether it's a 45-minute bar, an hourly, a 1440 minute, or a daily, or even a weekly or a monthly. So you have the flexibility and option to really apply these to any frequency or time series, and you can even apply to multiple time series. For instance, you could apply to a 45-minute and have, if you've allocated 100,000 to SPY, you can allocate 20,000 to a 45-minute frequency, and then 80,000 to a weekly frequency, and then allow the model to control the rest from there. And so on a dynamic basis, whatever form of analytic that it deploys. So if you have any questions, please feel free to reach out at contact Equity Sciences, support at equitysciences.com. We always maintain an open door policy, so feel free to reach out at any time. And again, our products and services, are meant to really serve a really broad range of objectives, while still being able to exploit the fundamental behavioral, technical, or linear biases of the markets that are applied to. And so again, here's some research pieces that we also, research indications that we've designed that deploy market classification. And so, for instance, these are designed to serve very specific purposes. So let's say, for instance, that you want to design a strategy that really wants to exploit volatility, right, in a very specific manner. And so you can deploy these to analyze or identify and break down different volatility conditions, different volatility classifications, or maybe it's momentum, right, that you want to exploit. And so these are extremely versatile. They come with open code, and then obviously, the input ranges can all be customized to serve very specific, objectives from, an analytic perspective. And so, these output, let's see, V5 and V3 basically output a figure from 1 to 64. They break things down. The others are classifying in a slightly different manner. But again, you can open those up, learn from how we classify conditions. So, they're serving multiple objectives at once. And so again, if you have any questions, feel free to reach out, at support at Equity Sciences, and we hope to hear from you soon. All right. Thank you.